This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Marking milestones, 2 straight record closes for the Nasdaq. The Dow and S&P 500 hover near their all-time highs, and there may be more to come.
Taking a breather, consumers gave their credit cards a rest, and that has some concern that economic growth may not pick up as much as hoped.
Priced out as some home prices soar in Silicon Valley. Even those with high-powered jobs can't afford to stay. Those stories and more tonight on Nightly Business Report for Friday, August 12th.
Good evening, everyone, and welcome. What a week and what a 6 months. Today was the Nasdaq's second straight record close. Just yesterday, we saw all 3 major indexes settle at new highs on the same day, something that hasn't happened since 1999. It was the 9th record close for the S&P this year, the 8th for the Dow. And that's something that would have seemed almost impossible earlier this year when stocks got off to their worst start ever. So, despite today's small moves, stocks remain near all-time highs. The Dow Jones Industrial Average fell 37 points to 18,576. The Nasdaq added 4, and the S&P 500 dropped 1. And for the week, all the major indexes eked out small gains.
But don't let the small moves fool you. Our next guest says there will be rewarding opportunities for investors in the coming months. He's Paul Schatz, president of Heritage Capital. Paul, you've been a lifelong bull. Has anything you've seen lately changed your point of view?
Absolutely not. In fact, the moves out of the Brexit low in late June, early July just added more confirmation to what we saw coming out of the February bottom, that this bull market has been rejuvenated. 2014 and 15 were pause years. They were digestion years. But this is a brand new, refreshed, recharged bull market. And as I've been saying since 2010, it's not going to end until we get to a minimum of Dow 20,000, probably in the first quarter of 2017.
Now, there are those out there, Paul, who say that the election looms large and that there are some global issues with emerging markets and even some developed countries that could put a halt to the Dow's advance. You obviously disagree with that.
Sue, a lot of the issues that the bears have really hung their hats on have been issues for 2016 and 15 and 14 and all the way back. The markets have this great way of digesting, pricing in, and accepting the known issues. So most of this is all priced in. I'll say this. The election we need to worry about is not November of 2016. The election we need to worry about is France and Germany in 2017. The market's pricing in Hillary Clinton as president. I think it's 70% likelihood today. But even if Trump got back to the margin of error, I think all you're going to see is a low to mid single-digit pullback that will just further recharge the market for a run above 20,000 next year. So unless you have some exogenous, really crazy, horrific event in this country, the market's long and strong, and I think people should be continuing to invest in it now.
Our Bob Pisani has been remarking in recent days about the rotation within sectors and within stocks, and certainly we've seen that this year, which is typically a sign of a fairly healthy market. So it's not all concentrated in one sector. Do you see it that way?
And I agree with Bob. Look, you've had the defensive, the yield chasers leading the market. You have utilities, staples, REITs, and telecom. They were the leaders. And that was concerning to the bears all along, and the bears were wrong. Now, since Brexit, you've got discretionary, you've got materials, semis, software. You've got these really more fuel-driven sectors that are leading the market. While it may be a little too far too fast, it's not something I'd worry about. You even have banks. I mean, I haven't talked about banks since 2006. Banks and even energy is kind of rejuvenating itself. So you've got this really broad-based, very powerful, very strong rally. Typically, it does not dissipate overnight. The AD line's making new high. Junk bonds are strong. Things are pretty good. Bears, come on in. The water's warm.
That's an enthusiastic call there, Paul. Thank you very much. Paul Schatz with Heritage Capital. Have a great weekend.
Well, one of the reasons, though, that stocks were a bit lower today was because of the disappointing retail sales report. Americans cut back on discretionary spending last month, potentially tempering expectations that overall economic growth may pick up. Steve Leisman has more.
After spending at a solid clip in June, consumers gave their credit cards a rest in July. The government's retail sales report showed that spending was flat last month after an upwardly revised 0.8% gain in June. The concern among economists was whether this was just a pause or if consumers who have been single-handedly holding up the economy might be ending their spending ways. Sales fell across a broad swath of categories for the month. Clothing, sporting goods, and department stores saw declines, along with grocery stores and restaurants. Gasoline stations fell a sharp 2.7%, but that was mostly the result of price declines. In fact, some economists wondered if part of the declines came from overall lower prices in some industries. Retail sales are not initially adjusted for inflation. Auto sales surged more than 1%, and online retailers bucked the trend and saw sales increases. Consumer spending grew in the second quarter while business investment and government spending fell. That led to just 1.2% in overall growth. Now, it's not unusual for a strong spending month to be followed by a soft one. But if spending stays flat in August, there will be concerns the economy might not be growing at all, or even that it's entering recession. So far, marquee retailers like Nordstrom and Macy's have reported better sales. Earnings from Target and Walmart, they're going to be watched closely next week. The Fed's going to be watching too. Soft consumer spending adds another reason for caution in raising rates. For Nightly Business Report, I'm Steve Leisman.
The prices paid by businesses fell in July. The producer price index dropped 0.4% from a month earlier, and that is the largest one-month decline in nearly a year. Producer prices had been picking up over the past few months, but a decline in energy prices weighed on the index this time around.
And oil prices keep climbing. Domestic crude was up 2%, settling at a 3-week high, one day after the International Energy Agency said world production is falling behind demand. And as we reported last night, Saudi Arabia is also playing a role in crude's recent rally. Jackie DeAngelis reports.
Crude oil prices are climbing higher on hopes that the world's largest oil producer is considering a production freeze. Earlier this year, a similar conversation between OPEC members brought no results. But some analysts are saying there's a $2 trillion reason why this time may be different. That reason is the sovereign wealth fund Saudi Arabia wants to launch. The kingdom's deputy crown prince has talked about taking Saudi Aramco, the state oil company, public in an effort to raise some capital for that massive fund. While an Aramco IPO isn't expected until next year or even 2018, oil in the 30s isn't helpful when you're trying to raise cash. A freeze would, in theory, increase prices and be more supportive of a successful deal.
We're talking $2 trillion. This is a lot of money on the line. So if you look at it from this angle, if they get a freeze in place and they are at record production, you multiply the record production times the higher increase in crude oil price, and they have a great IPO, possibly raising even more than $2 trillion.
A freeze hasn't happened so far because the Saudis and the Iranians haven't agreed. The Iranians are ramping production to pre-sanction levels and don't want to stop. In a game that's all about market share, the Saudis have felt pressure to keep up. But oil price fluctuations in the last 2 years have been all a result of supply-demand economics, specifically oversupply and not enough global demand to meet it. Total non-OPEC production is down nominally year over year, helping the rebalance. But according to OPEC's latest monthly bulletin, the cartel is pumping 1 million barrels a day more than it was last year. That's why a freeze is so crucial right now. The OPEC talks are expected to take place on the sidelines of an energy conference in Algeria in late September. Until then, crude oil pricing could be volatile. For Nightly Business Report, I'm Jackie DeAngelis.
Stocks tend to get a lift overall when oil prices do rise, but this year stocks haven't always been performing the way many expect them to. And it is turning Wall Street's conventional wisdom, some of those cliches you hear, upside down. Babazani takes a look at the reasons why.
The old Wall Street chestnuts aren't working, or are they? Several traders have inquired why the old chestnuts don't seem to be working anymore. As goes January, so goes the year. But the S&P is up 7% so far this year. Or sell in May and go away. But the S&P is up nearly 6% since the end of April. And August is the weakest month of the year, but the S&P is up fractionally, though it's still early. Now, what's going on? There's another major factor here. The presidential election years have an outsized influence on the markets, and when you layer in those signals, the markets are behaving in a fairly predictable manner. For example, the last 7 months of election years have tended to be strong, with just 2 losing streaks out of 16 elections since 1952. What about August being the weakest month? Well, August has been the weakest month for the S&P 500 since 1987. It's just the opposite in presidential election years. It's the fourth best month for the S&P, according to Jeff Hirsch at the Stock Traders Almanac. This may have to do with a post-convention bounce. How about sell in May and go away? It's not that simple. The correct rule is don't sell in May in the third and fourth year of a presidential election cycle. That's how important it is. What about as goes January, so goes the year? The proper interpretation of this rule is that every down January on the S&P 500 since 1950 has resulted in either a new or extended bear market, a flat market, or a 10% correction, one of those three. Hirsch insists that the January barometer did work with the correction that followed in January and February. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
To politics now. Democratic presidential nominee Hillary Clinton and her running mate, Tim Kaine, have released their tax returns. And the move was intended to ratchet up the pressure on Donald Trump to do the same. John Harwood joins us from Washington. Good to see you, John. So what did Ms. Clinton's return show, and what were her sources of income?
Well, let's talk about the top line numbers. Bill and Hillary Clinton made about $10.5 million in adjusted gross income in 2015. That's less than half what they made in the year before, and that's because she stopped making speeches, and Bill stopped making speeches once she became a candidate. They paid an effective federal tax rate of about 34.2%, gave 9.8% of their income to charity. Almost all of that was a $1 million donation to the Clinton Family Foundation. And as for the sources of income, $5 million was Bill Clinton's speech-making income. $1.6 million was his consulting income. She made $3 million as an author, $1.4 million on speeches before calling it quits and becoming a candidate.
Her running mate, John, Tim Kaine, also released his returns. What did we learn other than that he does not make anywhere near the money the Clintons do?
Just like Joe Biden, Tim Kaine is one of the least wealthy members of the United States Senate. He and his wife, Ann, had an income in 2015 of $313,000. They paid an effective tax rate of about 20.3%. And over the 10 years of the returns they released today, the Clinton campaign said that they had paid about 7.5% of their income in charitable donations. And as Sue noted at the top, all of this was about trying to put pressure on Donald Trump to release his. We know that he's worth $10 billion, or he claims to be worth $10 billion. We know that in some past years, he has not had income tax liability at all. And the Clinton campaign is trying to put front and center the questions of how much does he make, how much does he give away, and how much in federal taxes does he pay?
I'm sure they'll be talking about that over the weekend, John. We'll see what happens. Thank you, John Harwood in Washington.
Still ahead, Silicon Valley exodus. What happens when a city gets too expensive for even a CEO? There are reports tonight that General Motors expressed interest in buying the ride-hailing company Lyft, all of it. According to the technology website The Information, Lyft rejected GM and instead opted for a new round of funding. GM, which is not commenting on the story, already has a minority interest in that startup.
Silicon Valley real estate is hot, and for some, it's too hot. Earlier this week, we told you that the median price of a home in San Jose hit $1 million last quarter, and that's pricing people out. Aditi Roy reports from San Francisco.
The San Francisco Bay Area is famous for its beautiful scenery and infamous for the price to live in it. Just this week, 2 Bay Area residents with high-powered jobs say skyrocketing housing costs are driving them out of the area. San Francisco Federal Credit Union CEO Steven Stapp is taking another job in Portland, in large part because he pays $5,000 a month to rent a 1,500 square foot home in San Francisco.
As we looked at it, the money really goes a long ways in a city such as Portland, Oregon, and we've been very much challenged here in San Francisco to look at something that was affordable.
He says in Portland he can buy a home 3 to 4 times as large for half as much in mortgage. He's not the only one. Last year, year, more than 12.5% of Bay Area residents who moved elsewhere ended up in Portland. Earlier this week, Kate Vershawn Downing, a member of Palo Alto's Planning Commission, announced on a Medium post she was quitting her position and moving to Santa Cruz because she and her family can't afford the $6,200 rent of a house they share with another family. She's also a lawyer and her husband is a software engineer. Zillow reports home values in San Francisco are up nearly 8.5% from this time last year. Nationally, home values have risen nearly 5.5% year to year. One solution that's been proposed is increasing the inventory of homes, but that's touched off a lot of debate. Currently, there's a bill in the California legislature that would allow people to build homes in their backyard, but that's been met with opposition from residents who worry that would create crowded neighborhoods and parking supply issues. For Nightly Business Report, I'm Aditi Roy in San Francisco.
JCPenney's reports a smaller than expected loss, and that is where we begin tonight's market focus. Chain store said strong demand in the company's Sephora beauty business and its footwear lines helped results. Revenue and same-store sales rose, but both did come in a little bit shy of analyst estimates. The company also reiterated its full-year guidance. Wall Street liked the overall picture. Shares higher by 6% at $10.55. The Department of Justice said it is open to receiving settlement offers from Anthem regarding its proposed merger with Cigna. Last month, regulators sued to block the proposed acquisition, citing antitrust concerns. The trial is set to open in November and conclude by year's end. Shares of Cigna up 5% at $133.31. Anthem up 1.5% at $130.19.
Acacia Communications said strong demand for its technology products helped to lift its results. The company, which makes high-speed devices for communication networks, easily topped profit and revenue, more than doubled in the last quarter, in fact, and that sent shares soaring 41% to $95.67. Dick's Sporting Goods said its chief financial officer has stepped down. The athletic apparel retailer's current COO is expected to take on that role until a replacement is found. The company did not give a reason for the departure. The shares rose fractionally to $54.73.
This week's Market Monitor has 3 picks for your portfolio that he thinks are poised to improve over the next 2 quarters. He's Mark Lucchini, Chief Investment Strategist at Janney Montgomery Scott. During his last appearance in March, did pretty well. Mark recommended P&G up 5%, AT&T up 14%, and Eaton, which is higher by 16%. Welcome, Mark. You still sticking with those 3? You still like them?
Certainly 2 of the 3, Tyler, particularly Eaton and AT&T, attractive dividend yields, still very reasonable valuations. I wouldn't necessarily bail out of Procter & Gamble, but the fact of the matter is it's trading at about 20 times forward earnings, and I still think has some prospects for changing around its portfolio of products to help to improve growth rates, but that would be the one I'd be inclined to perhaps remove in order to make some room for today's 3 picks.
Well, let's get right to that. We start with the iShares Biotech.
Well, Sue, that's a space that we found recently very attractive. Several weeks ago, we went long exposure to biotech stocks. Rather than trying to pick the best house in the neighborhood, we're just trying to get the neighborhood right. So we came at it through IBB, the ETF that represents biotech stocks. The fact is, healthcare obviously has strong demographic underpinnings, but on top of that, there's increasing M&A activity in that space. A lot of the drug companies are looking for ways to reach out and ignite their R&D efforts through acquisition as opposed to intra-company investment, and we think that space ought to be able to prosper as a consequence. It did real well last year, got completely slaughtered, and now trades at very reasonable valuations in our view, so I think its prospects are good.
Your next pick is a little small, obscure, small cap in Redmond, Washington. Tell us about it.
Perhaps your viewers have heard of it, Tyler. It's called Microsoft. It's sitting on bundles of cash, a company that's actually growing rather nicely, and it's a cloud play. So as companies continue to outsource their computing databases, they're looking for firms, not just like Microsoft, but Amazon, Google, and others, to do that for them. The difference between the others and Microsoft is Microsoft trades at about 20 times earnings on a go-forward basis, which is reasonable when compared to many companies in the tech space, let alone their cloud-based counterparts. In addition, it pays just above a market dividend yield, so you get a handsome coupon as you own a cloud-based computing company that is doing a good job and it's an iconic brand.
And Cisco rounds out the 3.
Yeah, again, here's an iconic technology company, been out of favor for a long time. But what we're starting to see is telecommunication companies that have underinvested in communications equipment. And you mentioned another that had done real well on today's news, are starting to see the benefit of that underinvestment now finally turn around, where these telecoms, the AT&Ts and Verizons of the world, are trying to repair and restore their communication network capabilities. And so Cisco's a beneficiary of that, trading at just 13 times forward earnings against a market multiple of 17 times, and once again, a slightly above market dividend yield.
All right, Mark, thank you very much. As always, good to have you with us. Mark Lucchini with Janney Montgomery Scott.
Coming up, a big weekend for sports, and a big hello on one coast and a big goodbye on the other.
More big earnings on the agenda for next week. Here's a look at what to watch. Tuesday, the Dow component Home Depot reports its quarterlies. We'll find out if it's still benefiting from a strong housing market. Wednesday, the Dow component Cisco, which Mr. Lucchini just mentioned, out with earnings. And on Thursday, it's Walmart's turn. Focus will be on what the world's largest retailer says about the consumer, and that is what to watch next week.
The wait is over. Football is finally returning to Los Angeles, and it could help the nation's second largest market score a financial touchdown. Jane Wells calls the plays from LA.
It's been over 22 years since Los Angeles had a professional football team, and 37 years since the Coliseum was decked out in Rams colors. But the Southern California football drought is over. You nervous about Saturday?
Never.
Wide receiver Kenny Britt may not be nervous about the preseason opener against the Cowboys on Saturday, but a lot of other people are.
There's pressure on me every single day, but I never in my career looked over my shoulder.
The move west took years to achieve, with owner Stan Kroenke finally convincing other owners earlier this year to let him bring the Rams back for two reasons. The team could make a lot more money in Los Angeles than St. Louis, benefiting all of them, and he would privately finance a $2.6 billion state-of-the-art stadium, which could host future Super Bowls. Meantime, the Rams will have to spend at least 3 seasons in their old home, the Los Angeles Coliseum. But tomorrow's first preseason game is sold out, and even with over 90,000 seats, they're going to add seats to accommodate fans. Rams tickets are also doing much better on the resale market, averaging $235 according to Vivid Seats, up from $125 a year ago in St. Louis. That has moved the Rams up from 23rd place to 7th in resale ticket values. But Coach Jeff Fisher has yet to produce a winning season, something the Rams haven't had in 13 years. Do you think you have a sales job in this town?
No, I'm the head coach. I coach, but players play, and we do our best to win games. That's winning games sells tickets.
LA is ready for some football. How long it will wait for a winner is up in the air. For Nightly Business Report, Jane Wells, Los Angeles.
From football to baseball, where Alex Rodriguez plays his final game tonight as a Yankee after more than a decade with the team. His tenure included a big contract, the game's biggest at the time he signed it, and even bigger controversies. The question now is, did the Yankees' investment in Rodriguez pay off? Morgan Brennan takes a look.
A-Rod has earned more than any other Major League Baseball player in history, inking 2, at the time, record-breaking contracts that in total grossed $416 million over the course of his career, according to Spot-Track. But was he worth it?
He had a good agent, Scott Boras, who really showed owners that A-Rod was not only good on the field, but was a draw at the gate. If you look at the Yankees' first 2 seasons with A-Rod, their attendance increased 8% each year in 2004 and in 2005. And in 2005, they went over the 4 million mark in attendance, which is an incredible feat.
But his marketability eroded as the use of performance-enhancing drugs resulted in an unprecedented suspension for the entire 2014 season. Heading into A-Rod's final game, his publicist, Ron Berkowitz, says his client's image has come a long way from where it was just 2 years ago.
Fox Sports moved the game of the week. I don't know if that's ever been done before, from Saturday to Friday night, and cleared their Fox programming schedule and put this on up against the Olympics, for the most part, because he is such a big player, a megastar in the game.
Rodriguez will retire with more than a year left on his contract, with the Yankees paying out the remaining $27 million and retaining him in a special advisory role. The Yankees are by far the most valuable baseball franchise, worth an estimated $3.5 billion, according to Forbes. So what does this strategy yield the team? Well, room for new talent and a prospective mentor for those up-and-coming players. And of course, a revenue bump from tonight's home game, which is almost sold out. Just before Sunday's retirement announcement, the average ticket price was $76. Immediately following the announcement, that soared 500% according to TickIQ, but has since steadily declined, with an average price of $149 as of midday Friday. By comparison, the average ticket price for fellow Yankee Derek Jeter's final home game was almost $770. For Nightly Business Report, I'm Morgan Brennan.
Before we go, here's another quick look at how the markets closed this record week on Wall Street. The Dow fell 37 points, the Nasdaq added 4, and the S&P 500 dropped 1. We made it through.
We certainly did.
That's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
Stay cool this weekend.
I know it's hot.
All right, I'm Tyler Mathisen. You all stay cool as well. Have a great weekend. We'll see you Monday.